So we were talking about 4 building blocks. Financial management, we said there are 4 building blocks. First, what is the first building block? Accounting. Accounting. Book of accounts. You need to have book of accounts. So you need to have accounting standards. Number 2, planning, financial planning. Number 3, monitoring. Number 4, control. So these are the 4 building blocks is what we said. So you need to have these 4 in a financial management system. But how these 4 things act together? So that's what we will see before we go to the financial statements. See, we know that we have both short-term plans as well as long-term plans. Okay? And we need to have operational budgets. And operational budget is we need budgets for almost all operations. Whatever operations you do, you need to have a budget for that. Like projects, for every project you need to have a budget, for every program you need to have a budget. Okay, so budgets can be for any period of time, right? So typically we talk about 1-year budget. You can also have 5-year budget, right? So that you can have, but typically we will have 1-year budget. So first point is operational budgets. The second is fundraising plans. So for that also you need to plan. Where are you going to raise your funds? How are you going to raise your funds? For what you are going to raise your funds? So fundraising plans set out where we hope to get the money we need to support our operations over 1 to 3 year period of time. So this also you need to do, right? So first is budget, second is fundraising. Third, you need to do financing strategy, which means it is a long-term plan which sets income and reserves targets and sets out how they will be achieved. So you start from budget. From the budget you go to your what is the second? Fundraising. Third, you will go to financing strategy. Fourth, you will do all these, which means you will do forecasting the cash needs. Now we come to the short term. So during the program, so in the program implementation, so you do financial planning which continues, like you will do forecasting for the cash needs, and you will do contingency planning, and you will do monitoring the budgets. So these are the activities. So when we say financial management, these are all the activities that you should do in financial management, right? Of course, all these slides I will give it to you, no issues, okay? So you need not take it. If you think it is important, you can write, otherwise you need not write, okay? So these are, so whether it is going to be a short term or it is going to be a long term, when we say financial management, these are all the activities that are being involved in financial management that you should take care. And of course you are taking care. So these are all the things. So operational budgets, fundraising plans, financing strategy. While implementation, you need to do forecasting cash needs, how do you monitor those budgets, and what is the contingency plan that you have. So these 6 things are integral part of any financial planning strategy. So with this, our cycle is done. So we started off this cycle, plan, do, review. So when you now plan, set your budgets, you do, which means you receive and send project funds. Review means you compare the budget with actual activity. Then whatever the experience you have, you take it back to your next cycle. So this is where we started off and this is where we ended. So this is the cycle. Of course, there is a question, if you are interested, you can answer. In your experience, what makes a great budget? What do you think a great budget should have? What makes a great, you are all been doing budgets. So what do you call as a great budget, super budget? What do you call? What you should have in that budget? Based on the heads you are spending. Okay, so budget should have the details of the heads that you are spending. Is that what you are trying to say? Okay, yeah. What else? What you plan, what you do. Okay, a budget should reflect it. Nice. Then? Depends upon the activity. That is true. See, whatever we do is depending on what we act. Okay, so whatever the objectives that you have for that particular project, those objectives you should find that in the budget. Is that what you are saying? Okay. Nice. So the budget should contain the details of various activities that you have in a particular project. Okay. Right. Based on details of breakup. So the budget you need to have, okay, major heads, breakups. Nice. That's what contingency. Just right. I think our contingency in project will be more than the project cost itself. Output. Okay. So. Okay. Okay. So whether whatever you expected is actually been carried out and done or not. Okay. Fund flow, but will it be in the budget? See, in the budget, it's a basic, right? But budget is basic idea. This is what my project is. This is what the income that I foresee, right? And these are all my major heads, projects, right? Whether my income will be equal to my expenses, or should I have come up with something else as a source so that I will have more expenses than my income. Round of installment money will come only if you fulfill certain conditions. So you need to show that also so that you are ready for the next round. Great. Now to put it simply, the best budgets are number one, user friendly, right? So it should be very, very easy for you to understand. Once I see the budget, I should be in a position to understand, right, this is what I am trying to look at it. Second, it should be accurate and complete. It has to include all the costs associated with the project or activity, no errors. That's more important. Smart budget, okay. Today, except us, everything is smart. The phone that we have is a smartphone, TV I have is a smart TV, car I ride is a smart car, right? Except me, everything is smart around me. So fit for purpose, whether it is fitting for whatever the purpose that it is for. So that's what he said. So the right level of detail for the reader. So you need to have all these things in a budget. Let me show you, of course, you are all seen budgets, it's not that you have not seen, but my own academic interest. So this is, oh, I'm sorry. So this is one sort of a budget which is called income and expenditure budget, right? You all see it, you all do it every day. So this is for some other purpose. I just want to just show that to you. So these are the donors, right? So donors are going to give you for whatever the money, right? UC means whatever the currency, right? User currency. It can be any currency. So these are the societies or the trusts which are giving money. So these are the donors, and this is other. So bank interest you are getting, donations and fundraising you are doing, sales you are doing. Sometimes, you know, as NGOs you also sell, right? You sell some cards, or there are many activities by which you can raise money, right? If you have any sales of whatever products that you are selling, then training fees, right? You may give some training, whatever. So you look at the total income. So this is your income part. Then you have your expenditure part, right? So audit or accountancy, bank charges, board meetings that you have. So you show all your expenditures. So you show your income, then you show your expenditure, say depreciation, postage and stationery, right? So all these are expenses, right? So a little note on, of course, how many of you are using this depreciation in your accounts? All of us, most of us are using, right? Right. So whenever there is an asset, there is something called depreciation, right? So this depreciation, of course, this again from academic point of view, may I know what is depreciation? Why we do depreciation? Great. Asset as a annual maintenance. Okay, that's called repairs and maintenance. Depreciation is not repair. The value of the asset comes down. Okay. Why value of the asset should come down? I am using it. So as I am using, it has to come down. But how do I measure it? So any asset, you have something called as useful life. Yeah, true. If I have a building, then I need to have a life. Basically, we need to come to the life. That's very important. If building is, say, 15 years is the life, then whatever that I have spent on that building, I divide that by 15. Not simply. There is something called the salvage value at the end of the life of that particular asset. For whatever that I can sell it for, I will reduce it. divided by what is my useful life. So if it is useful life is 5 years, I will divide that by 5. If it is 15 years, I will divide that by 15. So it is simply what is the cost of that particular asset over its useful life. I am just sharing that cost over the useful life. So that is what is called a depreciation. Okay. So you have depreciation, postage, publicity, rent. So all these are administrative expenditure. So then you have staff expenditure, right? So what is that you are giving for your staff? Then you have a vehicle running or whatever. So you have basically expenses, then you have basically your expenditure, then you are going to see whether your expenditure is more than your expenses or income or vice versa, right? Then you put your contingency, then you see how much is your total. Then so this is your basic budget. So that's what all of you are also doing, just to show that this is how the budget will be. And this is your monthly summary cash flow. So every month you have to do this. So how much for January, how much is the incoming cash, outgoing cash, in whatever head it is, right? You just write that head. So DFID grant, for example, January you got this money, April, so which means every quarter you are getting that money. And so these are all the incomes you have. This is total cash in and this is total cash out. So you are trying to find out whether your cash in and cash out is tallying or whether it is going this way or that way. If you have more cash, maybe you can use it for some other purpose. If you have less cash, then you have to again either go back to the donor or you reduce your expense or you do something so this is going to match. So this is budget. So these are all the budgets that we have been using. So this all of you know. So when you look at a budget, right, there are some tips that are being given for creating great budgets. Of course, these are very simple tips and all of you know, you have been doing. So number one, it has to be organized. So whatever you do, it has to be organized. So that's number one. Organized means you need to have all information you have to have ready in advance. Example, activity plans, quantities, prices, right? So you need to start early so that you can review it periodically. So before it is getting operationalized, you need to review it very many times. So it is always better that you start your budget early. So this is number one, be organized. Number two, work as a team. So instead of one person doing the entire budget, is always better that you have at least the other person, so that wherever there is some problem, right, you can easily address. If possible, if anybody knows accounting or anybody knows finance, so in that case you can actually bring them in your team whenever you are doing this budget. So the best budgets are written with the help of those who will use them. So it is always better you have the person who is actually going to use it while drawing the budget. Third, keep clear notes. Like write your budgeting assumptions, right? So what is the assumption? You are saying that next 1 year, every month, this is what is going to be income. On what basis you are saying that you will get that income? Right? On what basis you are saying that this is what is going to be the expense in the next 1 year? So you have those back work with you, right? That need not be exactly be the same. Sometimes it will change, but while you draw the budget, to the extent possible, it is always better to have clear notes, clear assumptions. Attach price quotations. Ask yourself, would other people be able to understand my budget? Because I am not writing budget only for me. I am going to show this budget to the donor also. So if that is the case, the donor also should understand, right? So it is not that I understand what I am talking. I want you to understand what I am talking. Then only whatever I talk is useful, otherwise it is useless. Similarly, in the budget also, I am not writing only for me. I am also writing for the donor. So clear and justified calculations. So use a budget worksheet, right? There are a lot of templates available today. If you go to the internet, there are so many templates available. You can just bring that template, use it for yourself. It is not that you should create one. So today information is plentifully available, and you can please use whatever information that is available, right? You have all the budgets available. Cash budget is available, purchase budget is available. All templates are freely available over internet. You can use it. Of course, so the layout of a budget worksheet. So you have budgeted item, right? So this is how it is. How much? So then you have the notes column, which explains what the budget is all about, right? So this is about budgeting. These are the basics of we say financial management, right? Include all costs that is possible. there may be a lot of overhead cost. Normally in the budgets, the overhead cost, overhead means indirect, not directly visible, then it is called overhead. So overhead cost might be more than whatever is the direct cost. So make sure that all costs are associated with the project, both direct and shared cost, right? All those things are there in your budget. Find a budget buddy. So which means that somebody has to be there to check before you said this is what my final budget is all about. So it is always better somebody is saying you are wrong. Don't go with the person who will always say you are right. Go with the person who will say you are wrong. எடுப்பாறை இல்லா ஏமரா மன்னன் கெடுப்பான் இல்லானும் கெடும். So you need to have a person who says you are wrong, right? So normally what happens when we become boss, we want only people who will say yes to us. Whenever we have these people around us, we will never grow. So you need to have people who will say no to you, whatever you are saying is wrong. If you have that person, then you will grow. Okay, so these are, I don't want to cover them. So let's come to accounting and financial statements. This is what the template, if I say budget, this is how it should be. Is there any template that the donors normally give you? They give the template. So if they give the template, then to some extent, then the problem is solved. Because you are going to give in a fashion that he wants, not the fashion that you understand, right? Of course, that contingency is always a problem everywhere. So even in bigger projects, people will not accept more than 10% as contingency. So if you put 25%, 30% as contingency, they will definitely not. So that is why whenever we are doing this, we need to have all those, pre-planning or whatever, information you are getting. So you need to actually bring a lot of people together. As you said, you can't expect all these things to be done by poor people, which means that you need to take all the, responsibility on your shoulders. And particularly if you are going to run multiple projects, in that case, you will not find time for any of them. So I do agree, these are all the constraints that we need to live with. So maybe to the extent possible, whenever you are getting the budget, you can start early, think about all those things. See, some people, what they do is near their bed, they will have one notebook and pen. I've seen one or two of them, even my own family. So whenever they get any idea, they will immediately get up, say morning 2 o'clock, write and sleep. So next day morning they come, right? So there are a lot of people like that also. So these people who are kind of researchers, or who are the people who work or think a lot, so whenever any of the ideas comes in, you need to immediately, note it, otherwise you will forget it. You will never know when you will get it or not. I do agree. So all these problems are real problems that we need to face, but I don't think there is any quick fix for those things. So we need to live with that. So this framework I borrowed from CA Institute. It's called CA Institute, ICAI, Institute of Chartered Accountants of India. So this CA Institute, they are the ones who write the accounting standards for all the companies and businesses. Once, I think some 10 years back, they wanted to also have kind of an accounting framework for the NGOs, right? So I don't know after that what had happened. I don't think it has seen the light of the day. But they were talking about a few elements. So what they are saying is that the business that NGO is actually doing is not very different from the businesses that we have. Say for example, if an NGO is working for say water and sanitation, and you have real companies also which are working for water. You have Bisleri, for example. I'm just taking some off example, right? Say Bisleri, which is a brand, it's not a company, and they are also doing in water. So you are in sanitation, maybe there is another company which is doing also sanitation. So the nature of business is same. The only difference is that they are working as a corporate coming under the Companies Act, and you are NGOs coming not coming under anything. So we call either trust, or you have society, or you have Section 8 company. So previously we used to call it as Section 25 company in the old Companies Act. In the new Companies Act, we call that as a Section 8 company. So I think to my knowledge, we have only these three things. So for the trust, you have some Trust Act. For society, and trust and society is more dependent on the state. So for each and every state, it might vary. But when you come to the Companies Act, it will not vary. So it is constant throughout the India. So it is same. So Companies Act 2013 there is a section called section 8 under which you can start an NGO. But of course, they are not going to give you any great benefit. The only benefit they are showing is that when you see the income tax benefit will be more, because they give very many sections that are there in section 8 which will allow lot of reductions that you can have in your income tax. So that's the only advantage that I see in that, right? Otherwise, all these NGOs, they do not have any uniform codified financial statements. None of the NGOs are having. If 50 of you are here, 50 of you will be using different balance sheets, different income statements, right? You do not have any uniform codified. But when you look at the companies, all the companies, they have a uniform, right? If it is a profit and loss account, it will be exactly the same irrespective of whatever the company. But we have not come to that extent when we talk about NGOs. So accounting and finance in NGOs is, I will not say problematic, it is challenging, right? From that sense, it is challenging. So when you look at the elements of financial statements, basically comprising of income, expense, asset and liabilities, we know them, right? Principles of recognition of all of them, which means when do I recognize something as an income? So whenever the donor says, I will give you money, can I immediately write that as income? Right? I cannot. I will write that as income only if it comes to me. So this is what is called a cash basis. So when we talk about accounting, there are two ways of accounting. One is called cash basis, one is called accrual basis. Accrual basis means whether the cash is there or not, if something had happened, I will immediately take that into account. Say for example, I am selling something. I did not receive money, but I call it as a sales, right? Which means I have not received money. So whatever I have not received is what is called as an asset. So asset is something which has to give me future economic benefit. So in future I will collect from you. Today I am selling, in future maybe after 10 days you will give it to me. So I will not call it as a cash, I call it as receivable because I need to receive from you. Similarly, payable, I have to pay to somebody. So I will not pay immediately, but I will get the material. But I will pay later. So it is a payable. So this is what is called recognition. So you have cash basis of accounting, you have accrual basis of accounting, and all the people are trying to say that accrual basis of accounting is always better than the cash basis of accounting. But what is normally happening in most of the NGOs is you have only cash basis of accounting. Am I correct? You have only cash budget, you have only cash basis of accounting. You will not look into the accrual basis of accounting. But accrual basis of accounting is what world over people are saying that, because mostly the donors are international donors. Of course, today it is changing, right? You don't find donors, international donors. There are a lot of problems with the government. So you could not bring in foreign money. So those challenges are there. But still, even within India, if you look at bigger donors, say for example, you want to get from Azim Premji Trust, Tata Trust, because there are a lot of trusts which are actually helping NGOs to carry out all these works. So in that case, those organizations also might expect you to follow accrual basis of accounting, and it is not very tough. You can try migrate from cash basis of accounting into accrual basis of accounting, right? So the principles of recognition of income, similarly expenses. When I call something as an expense, right? So the accounting standard says when it is incurred, not that when it is paid. And whenever there is an income, there should be a associated expense. If there is an income, there should be an expense. There cannot be an income without an expense. There cannot be an expense without income. Both of them go together in accrual basis of accounting. So principles of measurement of items. So one is recognition. First is you are trying to understand what is income, what is expense, what is asset, what is liability. Second, you recognize when you call something as income, when you call something as expense, when you call something as an asset. Suppose I have taken a machine on lease. Can I call it as an asset? It is not my asset, but I have taken it on lease. I am using it. If there is any repair that is happening in the machine, I am only repairing it, right? So if that is the case, so whatever a ownership will do, if I have the expenses of the ownership, I should also have the benefits of the ownership, which means I will claim depreciation on that. That's a benefit. So that's what is called recognition. So can I recognize that as my asset? Can I recognize that as an income? Third is, how do I measure? So whenever we measure asset, for example, I am buying a machine, right? Machine is costing say 2 lakhs, but I need to transport the machine. Transportation charges say 5,000. Okay. Now, what is the cost of the machine? Is it 2 lakhs or 2 lakh 5,000? So that is the question. And once I bring the machine, I need to install that. Civil work, everything is say 2,000. So totally, if I have to put that machine for use, it is not 2 lakhs. I end up spending 2 lakh 10,000. Now, the accounting standard is saying that till that particular asset is ready for its use, intended purpose, I can capitalize, which means all these expenses like civil, transport, all those costs, I can take it as the cost of that asset. So the cost of the asset is no more 2 lakhs, it is 2.1 lakhs, right? So these are some of the benefits of accrual, system of accounting. So that is about measurement. How do I measure something? Then how do you present it? See, whenever we present in NGOs, we use fund-based accounting, because every fund is for a particular project, for a particular purpose. So for that purpose alone, I need to have this statement. So if I have 10 projects, I will have 10 different financial statements. Every fund, so it's called fund-based accounting, is what all NGOs are doing. So when you look at the accounting framework, as I said, there is no accounting framework, right? So every NGO is having its own framework. So this is because NGOs may be funded by numerous grants, donations, or similar contributions, which may or may not impose conditions on their usage. Sometimes they impose condition, you have to use only for this purpose. Sometimes they don't impose any of them, you can use it for anything. In other words, the use of some funds may be restricted by an outside agency, such as a donor, or self-imposed by the organization. You can also impose yourself, this fund I will not use it for anything else. It therefore follows that financial statements of NGOs should reflect income, expense, assets and liabilities in respect of such funds separately. So for each and every fund, separately I should have income, expense, asset, liability for each and every fund I have. Right, in respect of such funds separately, so as to enable the users of financial statements such as contributors to assess the usage of the funds contributed by them. So as I said, there are two bases of accounting, one is called cash basis, one is called accrual basis of accounting. NGOs under Companies Act, section 8 is what is covering, and it is actually talking about 3 levels of NGOs, right. So what are they, right? So this is the first level. All NGOs whose annual gross revenue, which is including grants, subsidies, donations, exceeds 50 crore for the immediate accounting year, they are called level 1 NGOs, level 2 NGOs, right? Level 3 NGOs. So level 3 NGOs is up to 1 crore. From 1 crore to 50 crore, level 2. More than 50 crore, level 3. So these standards are trying to say that whenever you go from one level to other level, obviously it will be more kind of a stricter. So you will use all these accounting standards that are given. Otherwise, none of the NGOs are using accounting standards presently. As I said, the regulation is, you have different acts which are different. So you have Trust Act is different, Societies Act is different, Companies Act is different, right? All these are different. Organizations such as trust societies, section 8 companies specify different accounting and reporting requirements which do not meet the current information. So requirements of various stakeholders like donors or contributors, intending grantors, regulators, lenders, government, employees, right, intending donors. So you have large number of stakeholders, and all these stakeholders, they require different sort of accounting statements. So the accounting statements per se are very different. I will show you some of the accounting standards which are being used by NGOs, right, to just give you an idea and understanding as to how it looks like. So NGOs frequently receive grants or donations or contributions and other forms of revenue. These are all income to them, the use of which may be either unrestricted or subject to restrictions imposed by the contributors, right. Further, there might also be legal or other binding restrictions. That's what he was saying. So if I have to go from one project to other project, right, there is a legal restriction, right? Otherwise, the fund will not come. Only if you fulfill this, you will get the fund. Otherwise, you will not get the fund, which means that I need to write the records for this particular, section. Then I need to give. So funds received by NGO may be divided into restricted funds. Sometimes endowment funds also comes with restricted funds, which means that you cannot touch the capital. You can use only the interest that you are getting, right? They are called endowment funds. So endowment funds are part of a form of the restricted fund. You can also have unrestricted fund where donations, legacies, right, investment income, fees, etc., they are all form of the unrestricted fund. You can have a corpus fund, right? Corpus fund is again, it is almost same as your endowment fund. So that's a corpus. This is the corpus that you have, and you cannot touch that corpus, and you need to protect that corpus. So in companies act and language, we call it as a capital maintenance. You need to maintain that corpus. So you are not supposed to touch that corpus. Only as a last resort, if there is no other go, only you can touch. Of course, with the permission of donors or the people who gave that corpus fund. Then you have designated funds. So designated funds in companies language, we call them as reserve. Designated for a particular purpose. It's called designated fund for a particular purpose. Then you can have a general fund. So which is the grants related to non-depreciable assets, right? Which means what? They are not for fixed assets, non-depreciable, because all fixed assets are depreciable. Grants of nature of founders or promoters contribution, they all will go into the general fund. Funds are generally represented by specific investments or bank balances. If appropriated means if I have a surplus, from that surplus, I have a designated fund. From that surplus, I include or I increase whatever the surplus that I already have. So it will go add on with the existing ones. So surplus is not invested specifically. It is usually called as a reserve and not fund. Right? If it is not been used, then you call it as a reserve. You will not use the word fund. Right? So these are some of the basics. When it comes to the financial statements, these are the four things that we need to have in our mind. Balance sheet, income and expenditure account. So in company parlance, we call it as P&L account or income statement. In NGOs parlance, we call it as income and expenditure account. Cash flow statement. So this is whatever the cash budget is, what you are translating into a cash budget, into a cash flow statement. Then notes forming parts of the financial statement. So these are the major ones. Now what I will be doing is, it's around 2:40. So I will show what is the all these financial statements with one of the NGO, and we will try to see how it has been arranged and ordered. So that will give us some idea. This is just to show how this balance sheet is arranged, right? Nothing great in that. So this is Corpus Fund. Now I hear from you that you cannot have Corpus Fund. Maybe you will call it as restricted fund today. Then you have other funds that you are getting, right? So it's a capital assets fund. Sometimes we call it as a building fund. Capital asset fund. You have a community projects fund, or there is the unrestricted fund, right? SCH means schedule. So these are the notes. So if you want to know more about Corpus Fund, you should go to this particular note. This will explain in detail what will be there inside that Corpus Fund, who has actually given that Corpus Fund, right? All those details will be there. Then you have a revolving fund. So as the name says, so it's a revolving fund. So whenever you are getting money from that fund, you will again put the money back, so it revolves, revolving fund. So these are the sources. And these are the liabilities, right? Of course, liabilities are also sources only. So you have restricted project fund, and you have secured loan. You got the secured loan. So secured loans means you are secured against the assets of the company. That is why it is called a secured loan. So which means if you are not going to pay the loan, those assets can be sold or confiscated, can be done anything. So it's called secured loan. Then you have current liabilities and provisions, right? So current liabilities, so these are the liabilities that you are supposed to pay immediately within 1 year is what is called current liability, right? So whenever we see the balance sheet, so See, whenever we have this balance sheet, say that this is the asset side of the balance sheet. Okay, so you have two assets. One, you have a current assets, then you have a fixed assets. Today we will not call it as a fixed asset, we are calling it as a non-current asset. So this is the asset we have. When you go to the liability side of the balance sheet, we have something called as the current liability. Then you have, this is a loan, whatever the loan that you are getting. Then this is your equity, which means, so this is your corpus fund. So corpus fund, other funds, revolving funds, right? All of them, restricted funds, unrestricted funds, all of them will be here. Restricted, unrestricted, corpus, right? All those funds, right? Donor funds, right? All those funds will be here. Okay, so what we essentially do is, these are the sources, these are the uses. So sources are called liabilities, uses are called assets. So when you put that in a box, maybe you will be in a better position to understand, right, what is happening. So I am getting, say, 1 crore from different forms. Maybe a part of that 1 crore, say 70 crore I got from all these funds from outside. Say that 5 crores or 10 crores is what I got, say, loan, and say that the excess is going to be your, so 20 crore is, say, going to be your 20 lakhs is going to be, say, your current liability, right? So you just divide your entire source into different sections in the balance sheet, and whatever is shown here is what is being shown there. The only difference is that we are showing that in a horizontal format, there it is given in a vertical format. So that is the only difference. Then you have assets. So you have current assets, then you have fixed assets. So current assets are the one which are going to be used by you within this 1 year. Current liability is the one which you are supposed to pay within 1 year. So which means that when you look at the maturity matching, we call it as a maturity matching. So you match the current asset with the current liability, and you match your non-current asset with the long term, right? So you should not use a current liability into this, right? So this is what is the problem with some of the companies, right? We heard about this Rayapeta benefit fund, and there are some funds which are devolved some years back, and there was a company called Anubhav Plantations company. So these companies, what they have done, the long term money is what they have used for the short term purpose, and the short term money that you can do, long term money I can use it for the short term purpose, so this is allowed, that you can do. But if you use a short term money for the long term purpose, in that case you will not get the money back. So you will not be in a position to pay your current liabilities when it falls due. So it becomes the problem, right? So what they have done is they got 5-year deposits from public, right, fixed deposits, and that fixed deposit they have used it in the real estate. They have used it in the teak plant. So teak plant will take some 20 years or 25 years to grow, and this is a loan which you are supposed to give in 3 years, supposed to give in 5 years. So which means that you cannot anyway give, because it will take 30 years for you to give the money back. So it's called a maturity mismatch. So you need to have maturity matching wherever it is. It is not only in teak, wherever it is. In your operations also, whenever anything is current in nature that you are supposed to give immediately, don't use that money for having a fixed asset, for the building. So for the building, for example, you use only the long term money and not the short term money, right? That maturity matching need to be there. So this says you have current liabilities, so which are the ones that you are supposed to pay, and provisions. See, provisions normally mean you are expecting some charges or some losses or some expenses, but you are not very sure as to how much it is. I know that it will happen, but I don't know how much it will be. Then I call it as a provision, right? So they are called provisions. So I need to provide for them, right? Then application of funds, as I said, you have fixed assets, you have current assets. So fixed assets, owned assets, then you have community assets. Then corpus fund investments, right? So investments are also assets, right? So some people used to have a third one here, which was called investments. But today what happened after this Companies Act, this investment, if it is a short term, it is merged with current asset. If it is a long term, it is merged with fixed asset. So there is no separately investments, but here you have that. So you have investments. Then you have current assets, loans and advances. So loans and advances are the ones that you have given. You are expected to get it back. They are called loans and advances. You can also get loans and advances. So in that case, it will be current liability. If you have given loans and advances to somebody, then it is called current assets. Right? So this is the balance sheet of this particular NGO, which is called Pradhan. And then they have their income and expenditure account, which is basically your income statement. So they have say donations, income from investments or deposits, and any other receipt. So whatever money they got, so in that particular schedule you can find, and what are all the expenditures that they had, right? So rural livelihood promotion program, they have livelihood promotion support, human resource development, R&D, this is research and documentation, not development, administration, and non-cash charges, right? Depreciation for the year, met out of capital asset fund, unrecoverable advances or unusable stocks, right? So they account for all of them. Then they see what is the excess of income over expenditure for this particular year. So this is their statement. So then they look at what is the surplus or deficit brought back, right? So and how it is apportioned, how it is divided into. So they are apportioned into Corpus Fund, Capital Assets Fund, right? So that's how it is apportioned into. So unrestricted fund is so much, and transferred to or from restricted from so much, right? So basically when you look at your financial statements, you will have balance sheet, you will have profit and loss account. And for that we have to understand what is asset, what is liability, what is income, what is expense, and how it has been arranged. So in a similar fashion, you must be in a position to understand the financial statements of a company, right? So if you have to understand, which means that you need to kind of do some analysis of financial statements. So once you know how it will be, so I will also show another so this is a guidance note. So this is the guidance note which was given by ICAI for the NGOs that they can use. So this is the guidance note on balance sheet. So if you want, I will pass on this as well. So this talks about the sources of funds, same thing, but it is a guided one. It is specific to Pradhan, but this can be used by anybody. So you have unrestricted fund, you have Corpus Fund, general fund, then you have designated funds, loans and borrowings, so current liabilities and provisions. So whatever we have seen there is what you could find here, and application of funds, which are basically assets. You have fixed assets, in that tangible assets, intangible assets. Intangible assets are like patent, copyright, know-how, right? Anything that you can't touch and feel, all of them are intangible, right? Brand, they are all intangible assets. Then capital work in progress. So which means something which is under construction is what is called a capital work in progress. Then you have investments, long-term investments, short-term investments, then current assets, loans and advances, right? And similarly, you have income and expenditure statement, where you have income from operations, fees and the subscription, grants and donations, then whatever the expenditures you have. Materials consumed, employee benefit, administrative, finance cost is basically the interest that you pay is what is called finance cost. Depreciation and amortization. We talked about depreciation. The same thing for intangible asset is what is called amortization. Then you have balance being excess of income over expenditure. So that's what you are going to transfer it to the balance sheet. So whether you are transferring to the designated fund or building fund or others, right? So this is basically profit and loss account and balance sheet. And once we have this P&L and balance sheet, which obviously your accountants will give it to you. So what you will normally do is statement analysis is what you will do. So these are the ratios that we normally calculate in NGOs to see whether this NGO is doing good or not. So one is called donor dependency. So how dependent you are with the donor, that's called donor dependency. So this is expressed as percentage, where it is total donor income divided by total income. So whatever is the total income, in that how much is the donor income? So that percentage will tell you about donor's dependency. So more the percentage, obviously more is the dependency level on the donor. So next is income utilization. So where basically you are trying to look at of whatever the total income, how much is the expenditure? Whether you are having more income or less income in comparison with your expenditure. So it is your expenditure item divided by total income multiplied by 100, because you want everything to be in percentage so that you can actually do a trend analysis. Trend means last year, this year, last month, this month. So over a period of say 4 or 5 years or 4 or 5 months, how this is changing is what is called a trend analysis. So for that it will be useful. Third is called survival ratio, where it is the general reserve, right? So where general reserves are, these are all unrestricted funds for general purposes under accumulated funds. Alternatively use net current assets. Sometimes we use the word net current assets. So general reserve divided by total income multiplied by 52. So which means what? You are looking at on a weekly basis, or multiplied by 365 if you are looking on a daily basis. That's what is called survival, and it is expressed either in weeks or in days. So how long you can survive, right? That's what is called survival ratio. With whatever the general reserves you have, if you don't have any other money, only the general reserve is what you have, then how long you can pull along is what is called survival ratio. And this is called acid test ratio. So whenever you have whatever the current assets you have minus prepayments divided by current liability. See, the answer should be in the range of 0.8 to 1.2. A result of 1 to 1 means there are sufficient funds to cover the immediate debt. So this ratio will give you an idea about whenever you have to give money to somebody immediately, which means current liability within 1 year, do I have enough assets with me so that I can pay whenever I am supposed to pay? This is what is called current ratio, right? That's the last one, current ratio, right? Current asset over current liability is current ratio. So this is what is called ratio analysis, or this is what is called financial statement analysis. And these are only 5 ratios is what I have seen, but in actuality you can have very many number of ratios depending on what information that you want to gather. Say for example, you also have ratios like this. You have something called Reliance Ratio, right? That's what we have seen in a different name. So largest type of income divided by total income, that's what is called donor dependency ratio. Same thing, here it is called Reliance Ratio. So you are relying on a particular type of income. Then reliance on government funding. So it means out of your total income, how much is the total government grant or the contracts, right? This is again a dependency ratio on the government. Then earned income ratio, which means how much ever is a total earned income, how much is that you are earning against how much is the total income, right? Some of the incomes you are not earning. Say for example, I am getting income as interest. Interest income is not I am earning from my operations, right? So it is your interest total earned. Then self-sufficiency. So total earned income divided by the total expenses. So when you look at the total expenses, how much is your income? The proportion of operating expenses that are covered by the earned income. Whether you are sufficient, self-sufficient, right? Sustainability, for that you have to use this particular ratio. Like that you can have very many ratios, like personal cost ratio, how much you are paying to your wages and taxes, benefit cost ratio, you can have administrative cost ratio, fundraising efficiency, right? So how much is the contributed income divided by your fundraising expense. So this is the average dollar amount of contributions raised from each dollar spent on fundraising. So for fundraising, how much is that I am spending? How much is that I am getting that as an income? So that is fundraising efficiency. Then cost per unit of service you are doing for each and every program, because you have a lot of program, lot of projects. For each and every project, how much is that program expense divided by units of service that you did. So if the non-profit uses program-based record keeping and has an identifiable unit of service, this ratio is very helpful in evaluating financial efficiency and in identifying the changes over time. And this current ratio, this is the daily cash on hand. How much cash is that you are having on hand, which is what we have seen as a acid test ratio, is what is explained here. Then debt ratio, how much debt is that you have against your unrestricted net assets to total liabilities. Then accounts receivable, if somebody has to give you money, then how long you are been waiting for that money. Money here I am not referring to the donors, money here referring from the service, you are providing the service, somebody is getting the service. So how much is that he has to give you money, receivables, right? So then payable aging, how much is that you are delaying your payments, that's called payable aging, right? So these are all what are called as FSA, financial statement analysis, and this is how in NGOs you look at the balance sheet, you look at the income statement, then you analyze those two statements with the help of these ratios.